With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put this show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, January 10th, 2025. A huge shout out to Daniel Venable, the newest addition to the BIG team. Man, what a great guy. We are so pumped to have him on board. He is just going to do a wonderful job. Really excited to have him there at the firm and getting his feet wet this week. So excited to see how that moves forward. As far as the market, though, not such a big shout out. But you know what? That's not a surprise, right? If you listen to this show, if you read the newsletter, you know that we were expecting the market to get sloppy. We raised up a ton of cash last week. I'm glad we did because things really started to roll over this week. So let's talk about it. Dow Jones down 1.8% this week. The S&P down 1.9%. The NASDAQ composite down 2.3%, and the Russell Small Cap Index down 3.5% this week. So everything having its rear end handed to it this week. Even long-term bonds, as measured by the TLT, 20-year treasuries there in that basket, down 2% this week also. Volatility index, as you might expect, up 21% this week, up to a 19.5. I mentioned that last week. I kind of thought the volatility index was too low. I thought it would spike up. We're seeing that happen. I think it can go higher still, so we'll see how that shakes out. I have to say, even though the markets have just been ugly, and they're all down for the year. Dow's down 1.4, the S&P's down 1, NASDAQ's down 0.75%. Everything's negative on the year. I'm pretty happy right now. BIG portfolios were up anywhere from 0.5% to just over 1% year to date. And really, we can thank energy. And we look at energy right now. Energy's up 3.2% year to date. And we are overweight that sector. You know, we kind of made some shifts there moving in towards the end of 2024. And we've beefed up our exposure to energy. The stocks are attractively priced. They're paying great dividends. And my thinking was that on one hand, there would probably be less downside. And on the other hand, there could potentially be really strong upside from these levels versus the S&P 500. So far, we're seeing that. That may not continue throughout the rest of the year. But the point of having that extra exposure was to create a balance in the portfolio against the S&P 500 if it were to get choppy. And so far, so good. It's doing its job. Other sectors, when you look at other sectors in the market, most everything was down this week except energy. Energy was up 1%. Healthcare was up 0.5%. Materials up 0.1%. Everything else was down 2 to 4% this week. So everything else taking a pretty big hit. Gold was up 1.9%. Silver up 2.3%. We have continued to maintain our exposure to our gold mining company, Kinross Gold, which is up 12.6% year to date. Again, having that diversity from the S&P can work out pretty nicely sometimes when things are not so pretty. Right? When the S&P is going up straight up and everything's all sunshine and lollipops, you just want all your money there and why bother these other things? But it's when things get rough that you're kind of glad you've got that money spread out and you've got these exposure to other asset classes. And so far, it's working out quite nicely. So it moved markets this week. Well, it was a shortened week. Thursday, the market was closed in honor of President Carter and his service on Thursday. But today, Friday morning, we had a jobs number come out that was just a blowout number. I mean, a blowout number, huge number, unexpected in a good way. And the unemployment rate ticked down a notch. And the market blew up today. You say, well, David, wait a minute. If the news was so good, why did the market blow up today? Well, that's because the stock market is addicted to crack cocaine. I'm sorry, not crack cocaine. It's addicted to cheap and easy money. Okay. The market wants cheap and easy money. It wants the interest rates to be lower. Lower interest rates, cheaper money, easier leverage, you can make more, etc. So the market gets a little spooked and goofy when interest rates go higher. And the Fed, at their last meeting, you might recall, they did cut rates, but as we expected, they cut rates with a caveat. And the caveat was, we're not really thinking about cutting so much moving forward. And the market's been hanging on to hope that data would come out to allow the Fed to cut rates further. A weaker jobs number, a bad jobs number, would have given the Fed the cover to be more aggressive at cutting rates. But a great jobs number, an unexpected blowout, does quite the opposite, right? It makes the Fed a little bit more concerned that the economy is still too hot and inflation's still staying pretty sticky. And therefore, the Fed is less likely now to cut rates moving forward, and the market's repriced to that information. They were repriced to that situation because higher rates hurt growth stocks in particular. Growth stocks get hurt the hardest because you're expecting future returns from growth stocks. And when rates are higher, you have to discount those future returns at a bigger rate. And it also doesn't play so nicely with high dividend stocks sometimes, because when treasuries start to be competitive to other high dividend paying stocks, that kind of takes some money away from them. So we saw real estate, for example, do poorly this week. Real estate investments were down 4%. So those are the dynamics. Now, one of the good things I have to say about this interest rate situation, it's been a concern of mine. Long-term rates are going up like crazy. Even though the Fed has been cutting rates for a few months now, long-term rates continue to go higher. They're going to close in on 5% on the 10-year Treasury. That's huge. And I've been a little concerned by what that means. What is the market trying to sniff out? Is the market worried about our debt? Is it a debt concern, or is it something else? Well, the good news is I think it's something else. I think the market's worried about inflation. And when we've talked about this as well, most inflation cycles that we've had, 87% to be exact, throughout history, have had two peaks. Where inflation runs up, inflation cools off, inflation runs up again. I think the market's starting to become fearful of that. And the reason why I think it's that and not the debt issue is that the government bond auctions have been pretty tame. They've actually been pretty good. I would become more concerned that the bond market's worries are surrounding our debt if the auctions were not going well, but they are going well. So that's a good sign. I think that this move in long-term rates is mainly inflation fears driving that. That's what I think. So with all that said, what are we doing? Well, as you know, we raised up a ton of cash last week. Thank goodness we did, because it's worked out quite nicely. I have put some of that to work. I bought some European exposure last week. That's actually up since we bought it up 1.7% in a week while the market's down, about the same amount. So that's worked out pretty nicely having that diversity in there. This week, I added some money to Southeast Asia, specifically Singapore, Indonesia, Malaysia, Thailand, Vietnam. That's down a little bit from where I bought it a couple of days ago. But again, I like the diversity there. And I think that that area of the world is very, very attractive right now on a valuation basis versus S&P and other areas. Aside from that, we're still sitting on a good chunk of cash. And I think this correction, I'm just not seeing the signs that say that we're there yet. I mentioned that last week. I thought we were just getting started, not coming to an end of it. So when you look at the S&P oscillator, it ended down 3.7 today. We want to see down 5 or more. And that's a good sign of washout. I like to see the volatility index spike up into the mid-20s. It's at 19.5. I like to see it maybe spike up higher into the 20s. That would be a nice sign. I would like to see the Tom DeMark indicators. We've talked about DeMark. He's a great technician. His formulas are fantastic. They do not show signs of downward exhaustion yet. And on top of that, we broke a key level of support this week, 5870. 5870 on the S&P 500 was kind of like a key level there that we broke below that. And now I think that opens the door for a test of the 200-day moving average on the stock market. That would take us down about another 5 or 6% from where we sit today. Not that we're going to wait till we get all the way down there, because I don't think that's prudent either, because you can miss it. But we are going to be looking to actively do some buying here as the market goes lower. For you new folks that have just come on board in the last month and a half, there's a lot of stocks that we haven't purchased for you yet. We've been sitting on some cash, extra cash, waiting for these stocks to drop. They're dropping now. So you might be seeing some extra purchases in your accounts. And for all of you folks that have been with us, as I said, we raised up all that cash last week. We put some in Europe and some in Asia, but we're still sitting on a lot. And there's things I'm watching. I'm doing some work. I mean, there's a great utility company that is really involved with powering these data centers and artificial intelligence. This looks like a great opportunity. I've been waiting for this thing to drop, and it's well below its 200-day moving average right now. So that's looking pretty attractive. There's some stocks in our portfolio that I still think look great. I mean, Alibaba, I think that's one of the cheapest stocks on planet Earth. If it goes lower, hits some washed out indicators, I'll be probably picking up some more of that. So in AMD, Advanced Micro Devices, a chip company we have, Lisa Su, brilliant CEO. It's a great company. We've made a 100% return on this stock 3 different occasions over the last 5 years. We bought it, sold it, bought it, sold it, bought it, sold it. And I want to buy more of it. And it's heading lower. So if it goes a little bit lower, hits a price target that I like, I'm going to be jumping in and buying some more of that as well. So, hey, I love the fact the market's going down. You know why? Because we've got cash. We've got cash. So when you've got cash, you can get excited. You can get pumped up. When the market is getting a beat down and everyone else is fretting, you can be excited and happy about it. And that's where I'm at today, excited and happy. I want to see it get beat up a little bit more so we can do some buying. So that's where we are. With all that said, we're going to wrap up. But between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's take that big trip, retire a little early, restore that classic car. Let me tell you, that's expensive. Maybe it is buy a big boat. That's about as expensive as it gets. They say boat stands for bring on another 1,000. More like bring on another 10. But anyway, I digress. Hey, you know what your goals are. Don't just think about them. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.